All right, so we're gonna see the daily closing thoughts of the first week of January 2023. So the question is like, what's gonna happen in the market? And if we look at the weekly, we are going into weekly resistance up here. We could technically say that this could be the weekly resistance. So any reclaim to the downside would be worth shorting. Boom. So it would be worth shorting if we spiked up, came back below the previous week's close, and started to go lower. And that would be, we're kind of in the seller zone. So that's kind of just the overview is that we haven't closed above weekly resistance here. And we're getting really close to a lot of sellers and uncomfortably close. Down here, it was more of like the buyer zone, and it worked out. It worked out in such a way that was really painful for those who were bulls who traded leverage, just because it was volatile. But that's what we see on the week. We are entering the bull trap area, so it's making bulls feel really comfortable right now. If we were to close above the orange line, we would be out of the bull trap. But that's not the case. All right, and then we go to the daily closes. This is now counting as support for a swing failure pattern right there. Deviation, left shoulder, right shoulder, resumption. It worked really well with the institutional bias being long. It's just the patience to wait through all of that, wait for a swing failure pattern to appear, was a feat in itself. And this is a very wide range. Now we have a H4 breaker that's untested, and then a fair value gap on the day that it's attracting it to it. And if it wants to establish equilibrium in price, it would fill it. We are not guaranteed that it would fill it, but it's highly likely. I would say around 51% likely, or it's probable. And then I don't know how high it'll go, but the higher we go, the more uncertain it will happen. Like the probability of uncertainty will go up the higher we go, just because we're getting into really bearish territory. The people who went long here are going to want to dump. This is the second chance for those who did not get to jump off the train to get off the train. And those who are getting bullish again, I don't know. It's going to be interesting. Fundamentally wise, the fundamentals, whether it's ISM manufacturing or it's the new orders, they look terrible. So they want the Fed, they want things to go back to equilibrium, and equilibrium is down. They want things to go down. Whether it's inventory, they want it to go down, or they want inventory to increase, or if they want demand to go down, those are all things that would affect the market going down. But we're currently at resistance. The question of how deep we're going to go is uncertain, but this is our daily support. We'll retest it, resume up. This is the first target. And then if it fails, this would be the deviation, and this would be the left shoulder resistance. So we're kind of waiting for that to happen. Something interesting to look at is using the 6-month or quarterly high as resistance at 38.7. And any reclaim to the downside below that level is a good short. On the weekly breaker and 4-hour breaker, we've broken to the upside finally. A nice retest into the monthly and yearly open would be a nice entry long to go to the upside for 1%, roughly. So not a whole lot, but enough to make, I don't know, a good $500 on futures for like small contracts, like maybe 3 micros or 2 micros. So that's roughly my expectation for a trade. And then going into oil, oil is volatile. I mean, it's a high beta thing. Going to oil, close the week, rejecting off resistance, closing below weekly support, broke that. We're into the weekly bullish order block, and we're going to see if it collapses. Based upon the daily, we broke support on the daily here, and we broke the secondary daily support, just dropping like a rock. And we're currently retesting 2 days in a row the resistance support that flipped to resistance, and looking like we might get a resumption to test these lows and maybe go lower. So that's the speculation on oil. So, but it doesn't look good. Go look here. According to this, we broke a 4-hour market structure break. Here we resumed to the downside for the weekly breaker retest resumption on the week. So we might wick up really quick to retest this breaker, or it might stay naked and it just might fall apart. We are putting in some kind of rising wedge formation, so we'll wait and see. It's uncertain, but at a minimum, the previous week low is just a target to the upside, which has an uncertain probability of reaching it. I honestly don't know if it will go touch it. Credit spreads. So the one thing that's in favor for that oil position going up and touching it, and the S&P 500 going up, is definitely credit spreads. Credit spreads are looking, I mean, it made a really good close. It reclaimed this weekly resistance that was resistance for 1, 2, 3 weeks. Now in the 4th week, reclaiming it. The thing about a reclaim is that it has to retest it and hold for it to be a real reclaim. So it's kind of like a scam pump. It's scamming. We're assuming it's not going to hold. So that's what would make it a scam pump, is that there's nefarious intentions, misleading and confusing the market. But currently, these are now support that was resistance. We'll delete these levels that's got these alerts, and we'll just do it like that. So now that's daily support and weekly support. We could go up into weekly resistance and daily resistance on the credit spreads, but eventually it's going to want to come back. So that's the downside of the credit spreads. But according to the long-term corporate bond credit spreads, it's not doing as well as the high yield growth credit spreads. So weekly resistance is here. It was support for this week and the week after, but then closed the week there. We could come back and fill this gap on the week. I don't know. It's possible, but in effect, we've created another gap on the day through this wick. So we could hold resistance here, fill the gap, come back down, and then fill this gap later down throughout the week. Who knows how volatile next week can get, but I'm thinking it's going to be pretty dang volatile because we got some news coming out next week, whether it's Fed Powell speaking or the CPI, and his thoughts would give us a window into his next move on the rate hikes. But it would be interesting next rate hike date. Is it February or when's the next Fed rate hike? So it's February. Scheduled for Tuesday, January 31st to February 1st. And we've already closed timing solutions, but that's kind of like the next point of interest is February and a possible rollover there. And I don't know. We have to kind of temper our bias to the short side. Maybe we might not win Covey's the uh, competition in January just because I don't know. There's two possible times where it could go our way, and as long as we can just keep on betting short, I think we'll be okay. The drawdown would be as big as what you think it would be. I mean, there's a max of 3% on the upside for the market, and that could totally draw down my gains. But as long as we keep betting on black, we'll eventually get it. But credit spreads, as long as we don't reclaim this weekly support on the long-term corporate credit spreads, and as long as the Japanese yen stays high, I think I'm going to continue holding short. So this is good for us being positioned short. The way the week closed, it hasn't really retested this weekly support as compared to the high yield growth credit spreads. I think they're a little optimistic. But at the same time, it needs to come down and retest, and that's going to be something to witness and behold what's going to happen. So going on to currencies. So this is kind of something that gives us more confidence is the currencies, and specifically the weekly close. The weekly close looks like it could be support for the Japanese yen to go higher. The daily close held. The weekly close held. On this flip that was resistance, got broken on this week, retested on the week after, and then another retest on the week after. We are just pretty much kind of consolidating, and it's good news to hear that we've held this support. Now it's just to reclaim this level, and it's unclear what's going to happen. It could go up here and then bounce and then go deeper. It's possible, just taking out these lows, but right now we got a fair value gap on the day, and we got to see does it fill and get rejected, or what's going to happen here. If it fills and gets rejected here, it's highly likely that February is going to be the date that would be the reversal. But if we blow through it and we reclaim the upside on the daily resistance, then I would say that this is the month that we'll see the downside. So we got it down to pretty much 2 months as to possible top, and we're kind of waiting and seeing the retest of these areas, whether it's the corporate high yield growth credit spreads or the Japanese yen and this gap, what really happens. So Euro. So the euro is also looking interesting. We're getting the picture slowly, one part at a time. But a fill of this gap would be like a really big deal on the bodies. I don't know how much that would be, but we would see interesting turn of events. This could be a sign like support's holding on the week, and gives it permission to spike higher. I don't know how that's going to work. Or it could be resistance, and there's enough bears in there. It's so just uncertain on what to think, but we do know it's below the yearly open, monthly open, and weekly open. So that could act as resistance going forward. So we kind of have to wait and see. But it's a point for the bears, at least, that they close the day below the yearly and monthly open. And then the Japanese yen is still holding above daily support. So those are the things for the bears that help its case on the Forex side. And then as far as the dollar bounced off weekly resistance, support that flipped on this candle close to resistance, retested on that week, and rejected, and then this past week that we just had, the first week of January, went into it and rejected as resistance. So now the question is this now resistance here on the week for further downside, or will we head higher? And according to the day on support, it's possible we could range a little bit on the dollar. We go back up and test resistance here before we go lower, and putting in a deviation head and shoulders on the dollar. So I would almost say like this supports the more upside kind of idea, but at the same time, the pattern as it develops would support more of a bearish kind of theme in just everything. If the dollar goes down, most likely the markets will go down too. If Japanese yen goes up, most likely the markets will go down too. If the euro goes down, most likely the markets will go, risk on equity will go down too. So that's pretty much the daily overview. It's a mixed bag. It looks like in the short term, we could head a little higher, but the question is by how much and for how long. And it looks like we got 2 points of interest. It's either this week we see something, or we see something by the next Fed rate hike, and it's just very news driven. And it really depends on how strong the market is. I think fundamentally you have to call into question if there's going to be a margin call before the next Fed meeting. If not, then we'll see it most likely in the currencies, and we will, and also the corporate credit spreads. Right now, the corporate credits or the credit spreads are a little uncertain. One is signaling a more of a bullish reclaim, and the corporate credit spreads versus the high yield growth credit spreads. The corporate credit spreads are just signaling weakness. So we just kind of have to give it more time, and maybe we'll get an answer by next week. So that's pretty much the daily overview, or the weekly overview. Thanks for watching. See you next video.